One of the first things that is important to know is what price is and how it is determined. It might sound trivial to you, but when I ask people, most of them don't know the right answer. The thing is that your success as a trader depends on the way you deal with prices behavior. For that reason, I want you to get a better understanding of how prices work before you begin buying and selling anything. Now, let's start with what price is not. A price does not reflect some absolute objective value of the asset it represents. In fact, there could be no relation between those two. Take the Bitcoin for example. It was sold within a range of $2,000 to $20,000 over the past year. However, nothing of the basic concept and the intrinsic value of it was changing during that time period. The price is also not what sellers offer to sell or buyers offer to buy. Imagine a situation where everyone wants to sell a certain currency at the price of $500. Does it mean that $500 is the current price? Not at all. Because if there is no one who is willing to actually buy this currency at this price, there is no meaning for that number. For instance, one buyer may come and offer to buy in $10 and people might actually sell it to him because they know there are no buyers at any higher price and they want to get rid of what they have. The same applies in the opposite side. If all buyers wish to purchase the same currency at $10 but no one is willing to sell it to them that cheap, they will simply not get it and eventually might go for a higher price. At least one of the sides will have to compromise and pay a higher price or sell at a lower price. Otherwise, their offers are merely theoretical bid and ask prices and they have nothing to do with the actual current price. Another thing to note is that price does not go higher because there are more buyers than sellers and vice versa. In fact, and logically, there is the same amount of buyers and sellers. The only question is which one is more eager to complete his transaction right now. So we know that there are mainly two types of traders in the market. The first type is buyers or bulls. They anticipate a rise in value and therefore looking to buy with the intention of selling it later on at a higher price. And there are the sellers or bears that on their end are looking to sell because they believe that the prices will go lower in the future, what will allow them to make profit from the difference. Naturally, there is a constant struggle between those two, as one side is looking to buy as low as possible and the other side is looking to get paid as much as possible. And practically, if each one of them remains stubborn, no trade will ever be made. At this point, something important happens. Each participant has to make a choice. The seller needs to decide whether he keep waiting until maybe at some point someone will be willing to buy from him in his requested price. Or alternatively, he can compromise and offer to sell at a lower price, what would increase significantly his chance to find a buyer and get a deal. Same thing with the buyer. Does he wait, hoping to find a seller who will compromise and sell to him at a lower price, or should he offer to buy at a higher price? A trade occurs when one of the market participants is more eager to execute a deal, when an excited buyer wants to get into the market and is willing to pay a little bit more, or a seller who feels pressure to sell now, even if at a lower cost. So the deal happens when there is a match between two different minds. Every price represents a temporary agreement between a buyer and a seller regarding the value of the asset they trade on. And every new price represents the latest match. Now, we know that in the markets there are bulls and there are bears, but obviously not everyone wishes to buy or to sell at any given moment. There is always a third part, the neutrals, undecided people, ones who wait to see what happens. Their importance is huge, because their presence put pressure on the buyers and the sellers to get to an agreement quickly, otherwise they might lose their chance, as the neutrals can always decide to get in and change the bid and ask balance. The price movement, the patterns it creates, and the volume of transactions all reflect the crowd psychology, what people want and how eager they are to trade. So once you understand mass psychology, you can much better anticipate market future movement.